As Augustin noted, the crypto universe is in turmoil right now. The ecosystem of crypto coins and shadow crypto banks that add layers of leverage and maturity mismatch through the system are showing considerable strain. Crashing prices and runs on shadow crypto banks highlight the risks to financial stability, and clearly addressing these risks is indeed an urgent policy challenge. But while we address these urgent challenges, we should not lose sight of the deeper structural flaws in crypto that make it unsuitable as the basis of a monetary system. And we need to keep the longer-term structural issues on our dashboard as we think about the future monetary system. Now, what are these deeper structural flaws of crypto as money? As Augustin noted, the first clue lies in the role played by stablecoins. Stablecoins, as you know, are cryptocurrencies that aim to maintain a stable value relative to traditional currencies, such as the US dollar. But the prevalence of stablecoins show the pervasive need of crypto to piggyback on the credibility of central bank money. It is a sign, if you like, of the search for a nominal anchor. Crypto started by turning its back on central bank money, but it has quickly rediscovered the need for a stable unit of account, which is best provided by real money issued by the central bank. So if you like, the prevalence of stablecoins shows that if central bank money did not exist, it would need to be invented. The same goes for money's role as a medium of exchange. Money is a social convention. We accept money because we expect others to accept money in the future. And money is the perfect example of the benefits of network effects, which entails this virtuous circle of greater use and greater acceptance. But crypto doesn't work like that. What is striking is that there has been a proliferation of crypto coins. The result has been the extreme fragmentation of the crypto universe. If crypto were suitable as money, we would have expected one crypto coin around which everyone coalesced. Instead, we have a severe form of fragmentation of the crypto universe, with over 10,000 crypto coins jostling for a place in the limelight. And gone is any pretense that crypto money can serve a coordination role. Now, the reason for the fragmentation of the crypto universe is that crypto runs under the banner of decentralization, where settlement is done through consensus formed by validators. Now, who are these validators? The validators can be miners, as in Bitcoin, or large holders of coins, or so-called whales, as in a proof-of-stake system. The fragmentation of crypto arises from the need to channel rents to validators and other insiders. And one way that rewards are kept high is through congestion. When the crypto platform is used intensively by users, transactions costs, and hence rents to insiders, tend to skyrocket. And this particular chart shows the relationship between the user fees on the vertical axis and the number of transactions on the horizontal axis for the Ethereum blockchain. So, if you like, unlike money, which rests on the virtuous circle of greater acceptance and greater use, crypto generates instead high costs, high rents to insiders, and congestion. And the fact that crypto is so prone to fragmentation makes it unsuitable as a basis for the monetary system, and that's what we conclude in the chapter. But as we argue in the chapter, everything that can be done with crypto can be done also with central bank money. Well, except perhaps for money laundering and ransomware attacks. But that's with good reason. So as Augustin showed, our vision for the future monetary system, as laid out in Chapter 3, is the fusion of enhanced technical capabilities around the core of the trust provided by central bank money. So the metaphor that we use for the future monetary system is that of a tree. Its solid trunk is the central bank and central bank money. And the tree supports a rich and vibrant ecosystem of services provided by private sector institutions and arrangements. In this tree, the ecosystem is rooted in the settlement on the central bank balance sheet. And this is the metaphor that really comes in. Everything is rooted in the settlement.
Would you agree that there is some fundamental non-zero value for Bitcoin? And if so, do you have a number for it?
That's a great question, Jim. Let me answer it like this. There is currently a very lively debate going on about how we can mitigate the risks from crypto. I mean, it's very, it's very current given recent events. And broadly speaking, there are two schools of thought in how we do this. One is like, one is to say, let's not touch this. It's what Steve Cicchetti calls let it burn. Just leave it alone. Don't even, don't even bring it into the house. It's just let it burn and just don't give it the credibility by regulating it. The other school of thought is the one that says, look, we need to, this is not going to go away. We need to regulate it by, imposing, the best regulations that we have. Now, I think it's not a black and white thing. I think there are different degrees. So, you could think about, these two schools of thought are, if you like, the containment school and the regulation school. It's not a black and white thing. You can think of, shades of gray here. You can maybe, forbid advertising, right? Why bring it into your living room and cause all this problem? You can prevent regulated institution from engaging in certain parts of this ecosystem. You could forbid initial coin offerings, which is still the case in many economies. Now, I think one of the issues with the let it burn school is that if you leave it outside the regulatory perimeter, it's not going to go away. And Jim, you've put your finger on it, which is that Bitcoin does have its uses. It's rather minority, but it does have some uses. But I would go back to what I was saying earlier. If we go back to that pure vision of crypto, and here I am including Bitcoin as part of crypto, in spite of what the maximalists say. That was a very different world if you think about it. So how many of us was running a node on the Bitcoin blockchain? It was really the preserve of a very small group of enthusiasts who really believe this stuff. I mean, and you could believe it because it conforms to your, political philosophy, your, libertarian philosophy about this. Maybe you value privacy a great deal, but it was not something that was going to take off because you were going to attract, selling coins to retail investors by going into their living rooms during the Super Bowl. And to that extent, yes, there will be a use. I think there will always be a use, and presumably the enthusiasts will have a value. I mean, if you collect bottle caps, you may be willing to buy and sell bottle caps, and it's not going to be zero. If you collect baseball cards, you may be willing to pay something for a rare baseball card. But I think that's the kind of activity that would result if we go back to the vision of the pure form of decentralized crypto. And in a way, I mean, that's not something that we should necessarily worry about, other than perhaps money laundering, perhaps, and financing of terrorism. But provided that those bases are covered, and there are ways of tracking the blockchain to do that, you shouldn't really be worried, and it wouldn't impinge on the conventional financial system. It would be very much contained. So I think the let it burn school probably is a little bit underestimating the resilience of crypto. On the other hand, I think bringing the whole thing into the house might also bring some, it's going to open the gates, and there will be consequences of that.